So how do you grow a trading account? I mean, that's the whole point of trading, right? They say that 90% of traders lose, and you don't have to do what the 10% do. You just have to avoid doing what the 90% do.
The numbers told the story, they always do.
In this video, I want to give you the framework to growing your account by focusing on consistency that comes from building a repeatable system that follows the same process and a solid strategy every day. I'm confident that if you implement these tips, you will begin to grow your account. All I ask is that you take a few seconds to go follow my Instagram, which I've linked down below. I post great tips and daily trading recaps that can be a great resource to learn from. I'd appreciate you helping me grow that account. Now, let's teach you how to grow your trading account. Let's get into it. All right, so we're gonna go over the blueprint to growing your small account, and this will work for any size of account. If you have a big account, if you're trading on prop firms, this is all gonna apply. It's gonna be really good stuff. So if you have a small account, you're gonna be subject to the PDT rule, which means you're gonna need 25,000 to trade more than 3 times a week. So you can take 3 day trades per 5-day period. There are workarounds around this. You can use a cash account, which avoids the PDT rule, and this works for options and stocks. So for example, if you have a $1,000 account, you can trade until this 1,000 is gone. So if you wanted to buy a $100 option, you could do that 10 times, right? And then the account would be basically at 0, and then you'd have to wait until the next day, and you'd have your $1,000 back. So how a cash account works is you have $1,000, you buy one $100 option. Let's say you make 50 bucks on it, all right? Get rid of this crude. Let's say you make $50 on it and you have $150 profit. All right. You will now only have $900 left to trade with for the rest of the day because you used that 100 and you locked it up. You made that 50. So if you didn't touch it and you didn't take any more trades, for the next day, you're going to have 1,050 in the account. That $50 profit will show up the next day. And you can do that. And you can trade as many times as you want until you use up your cash. The next thing you can do is you can trade futures, which requires a margin account, but there's no PDT rule. It's regulated under FINRA, which means you can take as many trades as you want, and there's no issue with that. So a lot of traders turn to futures for growing an account because they're not subject to the PDT rule, and there's less restrictions on it. And you do get tax benefits for trading futures. The next tip is that indicators lag. So price and volume show the complete picture. I've got rid of a lot of my indicators. I just use VWAP and a couple others, but I don't really look for entries off of the indicators. They lag. I'm using order flow. I'm using price and volume. Those are the most leading indicators. It's all you need. But if you have indicators you use, it's fine. It's just, we're going to talk about in this video, you want to build a system off of your indicators. You don't want to rely on them. You want to have a method to what you're using these indicators for, how you're finding the setups, and then how you're executing. I recommend trading the SPY or QQQ or the ES and NQ futures. This is the S&P 500, and then this is the NASDAQ. They are very liquid, and price action is easier to interpret. There's millions of contracts traded in the indexes every day through options, and ES futures will trade 1 million contracts a day on average. And it's better to be a master of one than a novice of many. So pick one and learn its personality and get good at mastering it and just focus on that one thing. Instead of looking at 30 different stocks every day or 10 different stocks, just look at the S&P 500, focus on that and learn how to trade that effectively and become a master at it. So if you're just trading stocks, typically they require a lot of capital to be effective. To make $500 a day on a stock like NVIDIA, trading at $120, to go for just a $1 move to 121, you would need to buy 500 shares, which would be a $60,000 position. Now, even half of that is $30,000 for just a $2 move in NVIDIA. Now, this is how to grow a small account. Most of you don't have that much money to put in, so stocks aren't favorable for growing a small account. Most traders turn to 2 trading products that give them the leverage to grow accounts without a ton of upfront capital. All right, so options and futures. So with options, they're leverage moves. You can have high % gains when volume and speed is present. You need a cash account to avoid the PDT rule. Otherwise, you're going to have 25,000 to trade freely. You can trade the SPX, the SPY, the NDX, or the QQQ. The SPY is the S&P 500. The SPX is 10x this move. So if the SPY is trading at 600, SPX is trading at 6,000. And and the NDX is the same sort of concept. So options expire, and you must get direction and time correct. It's a lot harder to manage risk with options because they will end up going to zero if you hold them too long, depending on their expiration. So they don't quite trade like stocks. There's that extra. It's like trading in 4D. You have to think about time and direction. Now with futures, there's no PDT rule, and then there's no time decay, so it trades more like a stock. It's a lot easier to manage risk with futures because it moves like a stock. You don't have to think about time. They can't expire. So there's a real benefit in that, especially for newer traders. Options can be really difficult because you have to think about picking an expiration. With futures, you can trade them more traditionally like a stock, and I find it's a lot easier for newer traders to manage risk and grow their account off of that. So there's micro and there's mini contracts. Like we have the SPX and the SPY, you have ES, and then you have MES, which is 1/10 the size of ES. Same thing as MNQ is 1/10 the size of NQ. Easier to manage risk, and they also trade 23/5. So if you're someone that has a time constraint, if it's hard for you to trade the full session, maybe you can't trade the opening bell or at all during the day, they trade at night, they trade at Globex. Right now, as I'm recording this video, futures are trading. So you can trade around the clock, and that's more favorable depending on your schedule. So we have the E-mini contracts and then the micro E-mini MES. So the E-mini contracts are $50 a point. So if you make 10 points, it's $500 in profit per contract. It requires margin, and brokers typically need about 1,500 to 2,000 of margin in your account to trade one contract. So to trade one of these, you would need it's about 1,600, depending on your broker. There's different requirements to trade, and that's in the regular trading session. You would actually need more than that to trade in the overnight session because there's a margin maintenance. But if you're day trading during the day, you need about this much in the account to trade one contract. And so in order to trade more, you need a bigger account. But you can start with a micro E-mini MES, which is 1/10, so it's $5 a point. So 50 times 10 points, you would make $50 per contract. Still requires margin, and a broker would typically need a minimum of $160 to $200 in an account to trade one contract. So if you have $1,000 in your account, you could trade 5 contracts, which would be half of an E-mini, $25 a point. I would recommend always starting with one contract and starting with one MES contract and work on that and slowly grow and scale before you go to the big boy. So, and I can't stress that enough. No matter how much money you have in your account, start with 1 to 3, no matter what. If you have a $100,000 account right now, trade one micro, making $5 a point. I can't stress enough. You're focusing on building a system, a strategy, a game plan that you're going to repeat every single day. And when you get that down and you've proven that you can trade, all you do is you just add contracts and you move up to the minis and you start trading 2, 3, 4, 5. You do that after you've traded well. You don't work in reverse. You don't go in and use all of your account to try and make as much money as you can because you're just going to hurt yourself. And this is about growing an account. It's not about how to make a ton of money really, really fast. So let's look at a movement of the options. On the left here, we have a SPY 0 data expiration 592 put, and we have an SPX 559.10 put. So this is how the contract moved. So for example, this is totally hypothetical. You're never going to get the bottom and the top, but this is to show you the movement of the options. If you're trading the SPY and you were to get in right here at this line, this one is $1 per contract. It's going to cost you $100 to put the trade on. If you're to buy one at 952 and take it up to this area, it would be worth $3, and you could sell it for a $200 profit, which would be like what, a 200% gain. All right, and these ended up going up to about 480. If you're trading the SPX, which again, if you're newer, I would recommend not trading the SPX until you've really learned how the S&P moves. Start with the SPY, and then you can start trading SPX. But this same area at 952, these contracts were worth about $4, 400 per contract. And if you were to buy one contract here at 4 and sell up here at this consolidation area, they went to $1,600. So you went from 400 to 1,600, and that's a $1,200 profit. SPX, and they ended up going to $2,800. SPX can be a huge asset if you know how to use it, and you can make some big gains pretty fast. But again, start with SPY. I'm just revealing to you, if you didn't know, the products out there are there for you to make money. So you can put $400 and turn it into 2,000 in a day, and it's realistic, but that only comes from having a solid system first. So don't go out and start buying these contracts like you're gambling, because you're just going to lose on them. This is hypothetical. If you were to buy here and sell here, you could make this. And again, even if you don't sell it at 1,600, if you buy it at 400 and sell it at 800, you made 100% gain. A lot of trading is not trying to catch the entire move, but just a good chunk of it. Now, on the flip side, if you were to short at 952, the ES futures, the bottom to high here, this is about a 65-point move from this white line down here to this area. One mini contract at $50 a point would make you about $32.50. And then one micro contract would make you about $3.25. Now that's bottom to top. If you come back here to the SPY, this went up to like 440 from 100. That's about $340. So it can be about the same as a micro on a big move like this, but you're not dealing with time decay. It's easier to manage risk. You can get in and place your stops at these pivots. When you're looking at the options, it's really hard because they're losing their value. And if this, for example, if the SPY were to rally, if this moved up right here, these contracts at 400 would have came down here and they would have been worth 0 by the end of the day. So that's your risk. So please keep that in mind. The first thing you always have to do is manage your risk by keeping your losers smaller than your winners. When you're trading the futures, if you are, you have a 3-point stop loss, you want to go for 6 to 9 points. You don't want to have a stop loss of 10 points and then have a take profit of 3 points. That's working backwards. You need to get rid of your fast money mentality. Grow means slow and steady. I'm going to go over on the next slide how a little bit of money can really sort of catapult you and grow over time. Everyone wants to come in and make this like one big trade where they make $4,000 in one day. And it's the wrong mentality to have, because you're not going to teach yourself good habits from the get-go. Throw away the money right now. You're focusing on building a system that you can repeat, and you're going to grow it slowly, and you're going to scale up, and the money will come in time as you grow and as you start to get better at trading, as you get better at managing risk. You're just going to increase your size, and then you're going to start making more money. So start small. All right, trading is the most scalable business. 1 contract into 10 contracts into 100 contracts. But like I said, start small. Trading is the most scalable business. You start with 1, you go to 10, and then you go to 100. You're going to have a proof of concept before scaling up. Proof of concept means that you have proven to yourself that you have a winning strategy, that you can be consistent, that you have a profitable month, that you can sit down in front of the computer and at the end of the month, you can be in profit. You've proven that what you're doing and the way that you're trading works, it makes you money, and then you scale up. You don't come in and have no data and are just back and forth, and then start scaling up. You hear about everyone like blowing these prop firm accounts all the time, and you ask them how many contracts they're trading, and they say 5 minis, and they've been trading for like 2 months. And I'm like, why are you trading with massive size? You should be trading with the smallest amount of size possible. This comes back to this fast money mentality. The stock market is not fast money. Everyone that you see that's posting how they made $15,000 in a day or this much money, it's like they've all been trading for like 10 years, 5 years, 8 years. Very few, no one comes in and says, I've been trading for 3 months and I make $10,000 a day. Like, they're lying to you. It's a year process. The fast money does not come. It's consistently growing your account, sizing up, improving your concept, and that's how you start making the big money. When you do all these things, you grow, you grow by having proof of concept, and then you scale. All right, now let's look at a hypothetical chart of if you were to trade 1 micro contract. This is the smallest contract possible. And hypothetically, if you were to make 8 points a day, what will your account look like after so many months? If you're trading 1 contract and you're making 8 points a day, now let's just assume, I know you're going to have losses. No one's going to just be $40 a day consistent, but maybe some trades are making 10 points or 15 points and 12 points. and then you lose 3, and then you lose 5, and then you make 17, and then you make 4, and then you make, let's just say your average is 8 points. If you start with $500 in your account and you do that for 2 months, at the beginning of the 3rd month, you're going to have $2,100 in your account. Now if you've done this, you have proof of concept. Hey, I just spent 2 months trading consistently. What I'm doing is working. I'm going to size up to 2 contracts. Now you're making 8 points a day average still because you're doing the same thing. And now you're making $80 a day. At the beginning of month 5, your account from 500 will now have 10x and it'll be at 5,300. And if you go, hey, what I'm doing works, I'm going to start trading 3 contracts. Now you're making 120 a day, which is 8 points. You're doing the same thing every month, the same setups, the same. It's like it should be mundane and boring. The same thing over and over again. $120 a day. At the beginning of month 7, after a little over half a year, your account will have $10,000 in it. And now you can say, hey, I know what I'm doing, and you can start scaling up. Maybe start trading 1 mini. You can trade 5 MES. You can trade 10 MES. 10 MES is 1 mini. Now you can trade 10 contracts, and then instead of trading 1 mini, you trade 10 MES, and then now you can scale out some of your position. You can, cut 7 or 8 contracts and hold runners. But this is hypothetical, and it never happens like this. But to get rid of your fast money mentality, this is way better and way more consistent than trying to make $10,000 in 1 trade or $5,000 in 2 trades. If you grow it through this entire time, you're going to be teaching yourself good habits. You're going to be learning what doesn't work and what works. You can optimize your trading, and you can really get granular, review everything, and set yourself up for success down the road. Because in order to be able to handle a lot of contracts, in order to have an average loss of $1,000 a day per trade, or an average loss of 4,000 per trade, and an average winner of 15,000 per trade, or 10,000 per trade, I'm sure you're watching this video seeing that as your end goal. I want to be able to make thousands of dollars a day, every day, by trading. You're not going to be able to manage that money, manage that risk, and locate setups and execute on them if you don't have a proven system that you can do with small size. And if you find yourself struggling, the number one thing I can recommend you to do is you cut back your size to the smallest size possible, trade 1 MES contract, and start from there and figure out what you're doing wrong and start fixing it without the fear of losing a ton of money. Do not go in trading max size. I can't urge it enough. All right, now let's talk about building a system. So when you systemize your approach, you teach yourself proper habits for identifying trades, managing your risk, and most importantly, avoiding bad trades. When you systemize your approach, you have no surprises. You know what's going to happen. You know where your stop is. You know where your take profit is. If you get in a trade with no plan and you have no stop loss, and then news comes out and you're down, 50% in a minute, you're going to freeze and you're not going to know what to do. And that's a surprise. When you have a system, everything is mapped out before you get in. You're calm, you're cool, you're collected. You're waiting for those setups to show themselves. And then from there, it's just a matter of repeating the same process and then scaling it up. Traders struggle because they approach trading by waiting for an indicator signal, and then they don't distinguish between what a good signal is and a bad signal is. So for example, maybe you're someone that trades the RSI, and every time the RSI is oversold, you buy it. You're probably going to have inconsistent results because the RSI is going to be oversold, but it's going to keep going down lower. And a lot of traders, they just learn to buy when it's oversold, or buy when it's oversold, and then sell when it's overbought, right? But they don't take it any further than that. I would encourage you to complicate it. And what I mean by that is you already know if the RSI goes to this level, buy. If it goes up to here, sell. Complicate it. Set parameters for it. How do you distinguish between what a good buy is and a bad buy is? Because what if you buy and it keeps dipping lower? Try and find a way to identify that so you can have an extra layer of confirmation and avoid maybe the bad RSI setups. Look further, really optimize that strategy, and find a reason beyond just the indicator itself showing you something. Maybe it has to be at a certain price level, right? Maybe it has to be under VWAP or over VWAP, you don't do it. Try and find something else besides just as simple as I buy when the RSI is oversold, because I would almost guarantee you're probably going to have inconsistent results because you don't have a definitive reason to set your stop, to your take profit, and then to avoid what could be a bad signal. Food for thought. So traders struggle because they have no process or no plan to manage risk, and they take whatever looks good. I would say avoid looks like trades. Oh, this looks like it's going to go up. This looks like it's going to go down. I mean, you need to have some sort of reason to get in other than it looks like it. The market looks like it's doing something every single tick, every single second. But avoid those bad trades. You need to be able to have a system that will identify your stop and your take profit and your reason for entry. And it's not going to be just one indicator giving you a signal. So let's talk about my process and what I do every day to locate trades. The first thing I do is I locate areas of interest. I do the open, high, low, or close of a range, of a candle, of a session, supply and demand. I look for outliers in the data, and I'll look at ranges. I wait for these levels to test, and then I observe the reaction at them. Then I formulate a trading plan that predetermines my risk and my profit target. I know where I'm going to be wrong, and that's my stop loss, and I know where I'm targeting to get out. And then I follow my plan and I resist the temptation to deviate. This is the hardest thing. I used to have a big problem with moving my moving my stop to break even too quick, or I would plan the trade. It wouldn't really do anything off the bat. It would almost hit my stop, come back up, and then I'll cut it because I don't want to take a loss. I think I'm wrong. And then it goes up in my favor. And so when you're in the trade, you're going to be tempted to deviate from your plan. And so you have to do whatever you can to work on it while you're in a trade. You can't work on this on the weekend when the market is closed. You can only work on it when you're actively in a trade and your emotions are active. You have to be aware, keep a notepad by you, write down your plan, tell yourself. Like I would tell myself, I'm not going to make a winning trade if I get out for no reason. I'm not going to make a winning trade if I close it here. Because just as much as the market can go down, it can go up. And if I'm in the trade, there's some reason I'm in that trade. So I don't want to change my plan after the fact just because I don't want to get stopped out. If I get stopped out, so be it. I'll review the trade and see if I can figure out what I did wrong and just avoid it next time. You have to review each trade and optimize your trading to current market conditions. You want to review every one of your trades either at the end of the day or at the weekend. So this helps. If you're taking 50 scalps a day, it's going to be really hard to do that. But if you're focusing on like really good setups, 1, 2, 3 trades a day, it's very easy to review those each day on the weekend and really look at what is going on and how you can, fix your trading and trade. This is how you can elevate trading. If you're struggling, trade less and really look at your trade, look at what went right, what went wrong. If you got stopped out, what could have you done differently? And if, it went to your take profit, great. Or maybe you cut it too early, like I was talking about, and then it went to your take profit. I need to go review that and see like what was going on that I decided to change my mind when I'm in a winning trade. You're only going to figure that out when you sit down and look at it and sort of have that conversation with yourself. And then part of my process is always moving my stop to break even once I'm up so many points in a trade. This is how I manage risk, and I found it to be effective for the way that I trade. I'm not saying that you have to do this, but typically my trades, if they go up a certain amount, they should keep going. And I found that if they come back down, I tend to get stopped out on them. So I simply manage my risk by moving my stop to break even and keeping that constant to avoid maybe potential losses. This is something that I've got from reviewing my data, and it's something that I would encourage you to review if it makes sense to do for your trading. I'm not saying that you have to do this, but I am telling you to look at your trading and see if this is something that you should do and if it makes sense. And then only take trades where you can make 2 times or more of your risk. We call this like a 2-to-1 RR, which is a risk to reward. So for example, if you're going to risk $100 in the trade, ideally you need to make at least $200 or more on the trade. If you can only make $30 on that trade, then you shouldn't take the trade. Even if you think it's a guarantee, you shouldn't take the trade because you're risking 100 to make 30. And over 100 trades, you're going to have a losing strategy and you're going to have a depleting account. A lot of trades I skip because it doesn't really make sense for the risk. If I have to have a 9-point stop loss and my take profit is like 4.5 points away, I'm just, even if I think it's going to hit it, I just don't take the trade because the risk doesn't make sense. It's no sense for me to do that. So you want to keep your risk consistent. So you change your contract size depending on where the stop loss is. So for example, if you are trading 2 contracts and you typically have a 3-point stop loss, let's say this trade, you hesitated, it's a little further up, now you have a 6-point stop loss. You shouldn't take 2 contracts on that trade. You should take 1 contract with a 6-point stop loss, and it's as if you are still trading with 2 contracts and a 3-point stop. So if you lose 300 on the 3-point stop with 2 contracts, you're going to only lose 300 on a 6-point stop with 1 contract. If you dynamically change your contracts, you can manage your risk, you can keep it consistent, and that is a secret to growing your account. A lot of traders don't do that. They have a 6-point stop, and then they still use 2 contracts, and then now it's like they got 2 stop outs on them. That is not how to grow an account. That is how to deplete an account. And again, like I said, 90% of traders fail. You don't have to do what the 10% do. You just have to avoid doing what the 90% do. If every trader averages into a loser, no traders average into a winner. Start doing that. It's tough, right? But 90% of traders, they size up when they're down. They don't keep their risk consistent and they average into losers. And that's why everyone has a tough time. And if you can see what everyone is doing that's not working, you just avoid doing it and you do the opposite of what they're doing. So let's talk about how I might, my process of like viewing trades is I might come into this NVIDIA chart, for example. We have this balance range right here. Balance range high, and I have the low right here. Typically, when we break under this low and we start to trade back up, we'll test the top of the range. So if we're in this area and this was the DeepSeek news, if we come down here, all right, this is the balance range. If sellers are present, this is going to continue to go down. If sellers are present and there's real fear and the buyers aren't around, it broke through this balance range. This kind of like it did right here. Not that this is a balance range, but let's say it was. This broke down and then it continued to go lower. It made a new range and it broke down again. We would want to see it continue to go lower. So I would formulate my trading plan. If this can reject this balance range low and come down, then I will be interested in going short. But if we can hold and start to trade up, I can take a long. This came back up to the range and it consolidated. Now, if I get long in this area, I can put my stop right underneath it. It's a small stop loss at about 118, take it all the way up to about 132. That's a pretty good risk to reward, right? This is how I might look at this trade. And I did take NVIDIA options on this and wrote it up. But this is just an example of how I might view the price action in the market and formulate a plan for both directions. Now let's look at an example on ES. So every day inside Full-Time Trader, I do my like pre-market plan and I kind of like go over what I'm potential setups I'm looking for. And I give a long and a short case since I don't know what's going to happen. So this was a Friday short covering rally right here. This chart is the right before the open, right before the bell. So this is what I'm looking at when I'm writing this. So I'm thinking if this Friday short covering can hold overnight, it's a bullish scenario as long as we stay above this 5940 area, which is this balance range low. And then the supply and key levels around 6015. And then so any break under 947 that does not stay below 5939 is a long setup for me. So if we come down here and we break 47, but we stay above 5940, then I'm going to be convinced that these buyers are going to be holding. But if we break under 5937, I'm going to think this is bearish and we're going to trade down lower and start testing this demand down here at 5870, which is right here. Those are my two scenarios. And this is what played out. So this red line right here is where I made the plan. So here's 5945. So what happened? We broke this area and then we started to trade lower right into, where this demand was, and we actually like broke through it. We came back up and then, what do you know? We're skating around this balance range low. We broke underneath this, consolidated, and now we're coming back up and tagging this. So from here, out of the same sort of setup on NVIDIA, to where if we can get above 58.58, and let's say we trade up, I would want to see us back test and hold this area. And if we can hold, then maybe this can move up and test up here to like 60.20, right? And then I would want my entry to kind of be right in this area, or maybe I get in kind of up here when I can confirm that. I don't want to get in this. I want to see it kind of like hold and prove itself to me. Consequently, let's say this peaks up, comes back down. Now I would want to see it reject this area and then start to trade lower. And then now I'm going to put my entry either at this 58.58 or maybe slightly lower down here. And then I'll put my stop at the 58.58. Two scenarios, right? The idea behind this is that if the buyers are really going to rip this up and fake out the shorts, we just swept this area, we came up, we held, we can go higher right here, right? The buyers are going to maintain control. But this isn't a downtrend. And if the sellers are really in control, they're going to do what they do. They're going to come back down below this area and they're going to hold below this consolidation zone and keep it going lower. Those are scenarios that I kind of look for every day. And I try and make a bull case and a bear case for what might happen. That way I'm not too biased on one side. I don't want to come in every day expecting to long, expecting to buy calls at the open. I want to really kind of give it two scenarios and then base my trading off that. Now, each day is different. I'm always looking at the order flow, and a lot of setups just show themselves during the day. And sometimes, this doesn't work out at all, but I like to get myself in the mode of thinking that way before. So it's something that you can consider doing. Now I want to briefly go over my order flow tools. Now I made a whole video series on this on my channel, and the link will be in the description below. I go over auction market theory, the footprint, and bookmap. So this is going to be a quick sort of rundown, but I would encourage you to go watch those videos. They're a lot more in depth, and they're going to show you how I confirm my setups using order flow. But the two tools that I use are footprint charts and a heat map or bookmap. This is bookmap right here, and this is my footprint charts up here. I have my depth of market. And just a very quick example, this consolidation area down here is right here on this candle. The red is selling, the blue is buying. I'm looking for trapped sellers. We come down here to this prior close. It's my support level. There's tons of selling, but price cannot move down. I'm looking for these sellers to become trapped. And on a move up, I'm going to buy right here and try and take it up. You can see this move was down here, and this was this huge move to the upside. You can see this on the order flow because there's tons and tons of selling and there's no follow through, versus a candlestick chart where you just see it bouncing and I don't know if it's going to go up and I don't know if it's going to roll over and go down like we saw in the last example. And then bookmap is this is the heat map. What you're seeing here is the green is large aggressive buying and the red is selling. And then these lines are the limit to passive orders. So at 6,005, there's 231 contracts waiting to sell. Down here at 96.50, there's 136 contracts waiting to buy. The thicker the color, I know the heavier the volume is. I can see we come up, right? Heavy buying, and then it sells off. There's an offer right here. It gets filled, and then there's a re-offer. Trades back up into this area. There's an offer that gets filled. There's buying at the top. It comes back down, and there's a re-offer. So this 605, there's someone selling there, preventing the price to move up. This can give me a signal to get in and short. All right, so that is how to grow a small account. I hope you enjoyed and learned a lot from this lesson. I'd appreciate it if you can like, comment, and subscribe to my channel if you learned something new, and check out that order flow series. And if you're interested in becoming a member, we have the full-time trader course where I have a more in-depth lesson on all my order flow tools, and then you'll have access to the Discord where I post my daily setups. But give me a follow and let me know what you thought about this video. I'll see you in the next one.